Hey there, it's James here from JD Scott& Co. How you doing? Um, Last week, Treasury released their proposal paper for what the government's proposing for changes to taxation of trusts. Now, this is really important. If you've got a small business, if you've got wealth creation, if you have a trust in place, understanding what's coming or potentially coming is vitally important. Now, this is only step one. This is Treasury asking the profession, people like me, what they think. Step two will be them proposing the law, and step three will passing that through Parliament. Now, first things first, what does their proposal say? Well, firstly, they want to tax trusts at 30%, which is the median or close to the middle range of personal income tax. It's also a larger company tax rate. Small businesses get taxed at 25 cents on the dollar. It's also the same rate that if you have investments in a company, what's a non-base rate entity, it's taxed at 30% as well. So the idea is to equalise across various sorts of entities. So how's this proposed to work? Well, what the proposal says is the trust will be taxed on its taxable income. Actually, not the distributions, which is kind of interesting. The announcements in the press and the government announcements were it'd be taxed on distributions, but that's actually not what the proposal says. So there's a subtle difference, which could be important in certain circumstances. So firstly, as I said, 30% of the taxable income of the trust. The trustee is liable. Okay, now for some trusts, that's an individual. So you could be, as an individual, liable for the trust's tax. For a lot of trusts, they have a corporate trustee in place. They can be $2 shelf companies. Most of them are, with any luck. You do that for various, protection purposes. So the trustee becomes liable for the trust's tax. And there's some discussion in there about who from a mechanical perspective, how do you do this? So we're going to have trust tax returns and a trustee tax return. That's one potential. So basically, let's double the administration for trusts. There's some discussion there about how to actually make that corporate trustee pay the tax. Okay, so the problem is this. If you've got a $2 shelf company and it owes $1 million in tax, well, it can just go bankrupt because it's got no cash to pay the tax. So the ATO is proposing a look-through mechanism so that the directors of that company become personally liable, which is not unprecedented in tax law. But at the moment, it's a pretty extreme situation to make the directors of a company personally liable for the tax debts of that entity. So again, that's another, smack in the face, if you will, for people who have a trust. Other issues are that the taxable income of the trust does not always equal the accounting income, and very often doesn't equal the cash. Okay, so you get cash in, you'll get accounting income, and you'll get trust income. And those three things could and very well will be different. But it's the taxable income that the ATO is after, not the cash. Now, this could be beneficial. For example, if you've, certain like capital gains, for example, might be more beneficial or might be okay under the scenario. Other situations may arise where the taxable income of the trust is greater than, say, the cash. And what do you do then? Don't know. So there's pros and cons to both, I think, doing that. Next step down is the trustee is liable, as we said, for the trust's tax. What then happens is the trustee then uses the franking credits, firstly, to pay the tax. And again, there's some discussion about what happens if there's excess franking credits. Is there a cash refund or credit pass-through? What happens there? But effectively, let's say you've got $100 coming into your trust as a fully franked dividend. There'll be some franking credits attached to that. That dividend is then grossed up and taxed at 30%. So you end up with $100 because 30% in and out will be the same number. That's distributed to the beneficiaries. All right. And the beneficiaries get a distribution with an attached credit to it. Now, the key difference here is, and the critical difference here is that if the beneficiary got a fully franked $100 dividend, they'd actually get a cash refund if they had no other income of those franking credits. Under the proposal, there is no refund of those credits you paid. So you've effectively burnt the franking credits. Now, if you're a top income earner making $200,000 plus, you're not going to care that much economically. The ins and outs will make sure that it's fine. If you're somebody who's got, say, a small, $50,000 of income coming in, maybe from the trust, you will care because your marginal rate will now go up. And so I always find it slightly ironic that we have a socialist government in place run by a prime minister who's on the far, on the left of the spectrum, who's actually disadvantaging people on lower incomes more than the wealthy. But that's how it works. What's excluded? There are a few things excluded, which is some good news. Fixed trusts are excluded. Widely held trusts. So you think your managed investments schemes, listed trusts, that sort of stuff. They're widely held. Usually, they're excluded. Super funds, of course, are excluded. Deceased estates, charities, and the government's also announced testamentary trusts are being excluded as well. Now, one of the problems with that is fixed trusts. The definition of a fixed trust in the law is very, very narrow. All right? A lot of things we think is fixed trust today, a typical unit trust, aren't fixed trusts after all. So you're going to end up with a two-tier system. And we deal with a lot of, say, property developers who do use unit trusts within their structures to hold property and to help manage their developments. They will weirdly be worse off under this compared to, say, a big corporate who's got, a big fund manager or a big property developer who's got multiple widely held trusts, because the widely held trust will pay tax and the small guy won't. So again, creating a distortion in the field, if you will, for property developers. The proposal also, as sort of has been in the press recently, killed off the use of bucket companies. Okay. So what does that mean, bucket companies? Well, the bucket company is you've got a trust and the trust owns a company and the trust distributes money to the company. And when the company collects the cash and goes and invests it, and at some point in the future, the company releases that cash back out by way of a franked dividend. Very, very common strategy, used a lot for wealth creation purposes in Australia. Lots of small businesses have these. It helps you separate out the entity that holds the wealth from, say, the risky business assets. Okay, so it's very, very common. Now, what's going to happen here is that there's double taxation, effectively. The new rules say that corporates don't get the credit. All right, so what does that mean? So, got a trust pays 30% tax, or the trustee pays 30% tax. That, let's say that distribution went to the bucket company. All right, have $100 as a fully franked dividend. Okay. So let's say we have $100 of income in the trust. The trustee pays $30 in tax, off it goes. $70 cash is paid down to the bucket company. Now, for tax purposes, that's grossed up. So the bucket company now gets $100 of taxable income, $70 of cash. The bucket company then pays tax on the 100. Okay, so it pays 30 cents on the dollar on 100, so $30 in cash goes off to the ATO, leaving it now with $40 in cash. However, it doesn't get a credit for that tax that's already been paid. Okay, so if an individual got the 100, they would be taxed on, say, they would get $100 taxable income. They'd pay 30 cents tax, or be liable for 30 cents tax, minus the credit the trustee has already paid. However, the corporate receives $100, gets no credit for the 30 that's already been paid. It pays its tax, all right, and is left with $40 cash. And so you're effectively ending up with a 60+% effective tax rate in the company. So your $100 cash ended up being $40 cash in the bucket company. Now, the ATO, also the Treasury has said that yes, the company will get franking credits for the amount of taxes paid, but the problem is you're going to end up with trapped franking credits. And what do I mean by that? Well, the profit that goes into the company is 70 for accounting purposes. It's not 100, it's not tax, it's accounting, 70. So it's got $70 of profits. That's what it pays out. And so even if it fully franked the dividends, there'll be a few bucks left of franking credits trapped in that company, which you can never, ever, ever use. So it is effectively double taxation. And it is quite a horrific outcome for structures that have been widely used. Okay, proposed start date for this is 1 July 2028. The only good news, I suppose, well, it's not really good news. The only good news, I suppose, is the Treasury and the government are allowing or proposing to allow people to restructure their affairs with no tax penalties. So at the moment, if you restructure your tax affairs for tax outcomes, you might be hit with Part 4A penalties. The changes allow you to move your assets out of a trust, move them around with no penalty, which is at a federal level great. However, that doesn't include state taxes like stamp duty. So if you've got land in a trust, you're stuffed. I don't see state treasuries giving tax concessions to anybody to allow them to restructure their affairs. So for as far as taxation goes, for structures we've had in place for decades, 100 years in some cases, those structures will need to be rewound, unwound, redone, put back in place. What are we recommending? At the moment, nothing. Until we see the rules, it's kind of hard to say what we recommend, but it's a watch this space. Either way, though, We do expect legislation by the end of the year. And as I said, it will add another level of complexity on top of an already complicated tax system. Trusts themselves, the trust law is really, really complicated and very easy to screw up. Plenty of even big four firms have made mistakes over the years with this sort of thing. So this is just adds another level of complexity upon an already very complicated tax system. Till next time. Cheers.